Markets are sending fundamentally contradictory signals right now. Japan's central bank just hiked its key policy rate, moving it all the way up to 0.75%. That's the highest level in 3 decades. But immediately the yen sold off. It's now trading around 157 to the dollar. And at the same time, while the S&P 500 continues to rally, gold has just spiked vertically, hitting an all-time high of $4,420 an ounce. This is Neural Pulse. Let's analyze.
What we're tracking here is what we call the paradox of convergence and division. You have these superficial efforts towards stability, but they're masking a much deeper, intensifying structural conflict. The old playbooks for finance, for geopolitics, they're just failing, and these anomalies are the result.
Okay, let's unpack that. I think we should start with the clearest, most kinetic flashpoint we're tracking, which is in the Caribbean. We're at the peak of Operation Southern Spear, led by U.S. Southcom off the coast of Venezuela. And this isn't just paperwork. We're confirming physical enforcement.
That's the crucial distinction. I mean, this is the difference between sanctions as financial pressure and sanctions enforced by a gun turret. The U.S. Coast Guard and Navy are executing what they call maritime interception operations, or MIOs.
So physical seizures.
Physical seizures. They've confirmed taking the Panamanian tanker Centuries, and we know they're still in pursuit of the Bella One.
And the scale of this deployment, it's just unprecedented, isn't it?
It is. This is the largest U.S. military presence in the Caribbean since the Cold War, and the violence is escalating. We're talking airstrikes against vessels, over 20 since September.
With over 100 casualties, this is a genuine shooting war at sea.
It is, and what's critical for decision makers to grasp is the legal framing of this escalation. These MIOs are, for all intents and purposes, an act of hybrid war. But the U.S. is framing them as law enforcement.
Well, law enforcement against what?
Against narcoterrorism. They're using specific provisions within ANCLS, that's the UN Convention on the Law of the Sea, that are really intended for piracy or for stateless vessels. It allows them to carry out what is essentially state-on-state economic enforcement while bypassing a formal declaration of conflict.
I'm curious about the timing, though. Why now? Why can the U.S. take on this level of physical risk right at this moment?
That is the core of what we're calling the sanctions paradox. Normally, if you physically remove Venezuelan crude from the market, global oil prices should spike.
Right, which would create immediate political pain at home for the U.S.
Exactly. But right now, global WTI crude is constrained. It's hovering around, $57 a barrel. That's driven by global demand and recession fears. So this low-price environment gives Washington the political maneuvering room to be this aggressive without triggering a domestic panic over inflation.
And here's the direct takeaway for anyone managing logistics. The second-order effects are already hitting the bottom line.
Absolutely. The risk of seizure has created an extreme chilling effect on international shipping. It's not theoretical anymore. We're seeing tank owners actively diverting their routes, significant changes toward the Indian Ocean, just to avoid the entire Caribbean risk zone. And that flight from risk is driving up insurance premiums for all maritime transport, which cuts directly into global profitability.
And the most immediate risk we're watching is accidental engagement. A Venezuelan naval escort tries to protect a tanker. It clashes with the U.S. Navy.
And you could see WTI crude prices jump over $70 almost instantaneously. That would pull the rug right out from under Washington's current freedom of action. And that kind of localized kinetic event translates immediately into radical instability in the core financial system, which brings us directly back to the currency anomalies we're seeing in Japan and this global flight to hard assets.
Let's follow that money. So on December 19th, the Bank of Japan makes this bold move. They hiked the policy rate from 0.25% to 0.75%. It's a huge half-point jump, highest rate since 1995. Conventional economics says this should have sent the yen soaring.
And the market just said, no, thank you. The reaction was completely counterintuitive. We saw the yen slip. It's now testing that crucial 157 to the dollar level. And the bond market showed the same lack of confidence. The 10-year JGB yield jumped to 2.1%, highest since 1999. The market just doesn't believe the hike will work.
So why did the textbook move fail so spectacularly?
This is the JPY paradox, and it's driven by this fear of what's called fiscal dominance. The market looked at that 0.75% hike and saw it as too little, too late, especially when you compare it to U.S. rates, which are sitting around 3.50%. But more critically, the hike itself just raised panic about Japan's massive debt burden, walking over 260% of GDP.
So let me see if I can break that down. It's like Japan has a crippling amount of credit card debt. A small rate hike doesn't solve the underlying problem, but it dramatically increases the cost of just servicing that enormous debt.
You've nailed it. That is fiscal dominance in action. The market believes the central bank is now trapped. It has to prioritize saving the government's budget over fighting inflation or strengthening the currency. And that fear is only amplified by the signals from the finance ministry. Minister Mamura expressed deep concern, which is really the last diplomatic warning before they deployed actual currency intervention if the yen tests 160.
And this growing distrust in fiat currency systems is showing up globally in the gold market. While the yen is struggling, gold is absolutely soaring.
Peaking at $4,420 an ounce, with silver surging near $69. This is the gold paradox, and it reflects this profound market cognitive dissonance. You have the S&P 500 and gold hitting all-time highs at the same time.
Right. One group of investors is pricing in a soft landing and growth. That's the stock market.
And a parallel, and I argue increasingly powerful group, is pricing in system failure, accelerating de-dollarization, and just core instability.
And we know exactly who's in that second group. We have hard data showing that central banks, particularly from the global South, China, Russia, India, collectively bought a record 1,037 tons of gold in 2024.
Exactly. This isn't just retail fear driving the price. This is institutional strategy. It's the ultimate hedge against the very instability we were just discussing in the currency markets. They're deliberately reducing their exposure to Western fiat systems.
This underlying financial instability seems to demand some kind of stabilization elsewhere, which leads us to these high-level attempts to manage the U.S.-China relationship. Let's look at the truce reached after the South Korea summit. What are the material facts?
It's essentially a mutual tactical de-escalation of the supply chain war, and it's driven mostly by economic necessity. China agreed to effectively repeal the export restrictions they put on rare earths and critical minerals back in October. We're talking gallium, germanium, graphite.
All essential for global manufacturing.
And critically, they also promised to stem the flow of fentanyl precursors to North America.
And what did the U.S. have to give up to get that? What was the concession?
Two key things: a 10% tariff reduction on fentanyl-related goods, which is more of a symbolic gesture. But the big one was a one-year freeze on the Section 301 investigation into Chinese shipbuilding. That investigation is a potent trade weapon, so pausing it is a major concession.
So is this a genuine turn towards peace, or just a momentary breather?
It's a recognition of what we call economic mutually assured destruction. Economic MAD. Both sides pulled levers that ended up hurting themselves. China's economy is struggling, growth is below 3%, it needs export stability, and the U.S. needs to avoid the inflation and the production delays in military EV and semiconductor lines that these rare earth shortages cause. This wasn't a friendship forming, this was like two boxers who accidentally stepped on each other's feet and needed a moment to reset.
I have to imagine hardliners in Washington view this with immense skepticism, exchanging reliable tariff leverage for promises on fentanyl that are notoriously hard to verify.
That skepticism is entirely justified. I mean, China just demonstrated its ability and its willingness to use the strategic materials tap as a weapon. They know that turning that tap off causes immediate significant pain in U.S. strategic sectors. So this agreement is just a temporary ceasefire until the end of 2026. The long view is that China will use this time to accelerate its fortress economy strategy, not to foster deeper integration.
And even as they try to manage trade, conflict itself keeps mutating, both on the ground and digitally. Let's look at the intersection of cyber threats and manufacturing, starting with the Jaguar Land Rover crisis.
The JLR crisis is just a staggering example of how deep digital integration creates physical vulnerability. We're tracking an estimated loss of $1.9 billion. That stems from a 5-week production stoppage. And the second-order effect is catastrophic. It's triggering bankruptcy risk for Tier 1 suppliers, creating parts shortages globally. This was a direct assault on business continuity.
And now there's a new generation of threat, something called lies in the loop.
Lies in the loop is a profound tactical shift. We've spent years building defenses using a human in the loop to approve AI suggestions. This new technique is designed specifically to deceive that human approver. So imagine an AI suggests a solution to optimize a process, but it subtly alters an error margin just enough to cause component failure weeks later. A tired human approves it because it looks correct. That's the new reality. AI defense is now being attacked by AI-driven deception.
Pivoting back to kinetic conflict, let's look at Ukraine. Despite these ongoing secret peace talks in Miami, Russian forces are conducting small, strategic cross-border attacks into the Sumy region.
And this illustrates what we're calling the Ukraine paradox, peace through conflict. That Sumy offensive isn't about mass occupation. It is a cognitive warfare tactic. The goal is to force Kyiv to divert resources and to psychologically pressure the West into thinking things are collapsing. These attacks create leverage for Russia in those very same Miami peace talks.
Meanwhile, in the Middle East, we're seeing these fluid, pragmatic alliances. A high-level Turkish delegation just visited Damascus to pressure the new Syrian government on disarming Kurdish forces.
This is pure Middle Eastern pragmatism. It's a classic case of the enemy of my enemy. Turkey is now willing to partner with the Damascus government they once tried to depose because the immediate threat of Kurdish autonomy from the SDF overrides everything else.
And finally, the low-intensity war between Israel and Iran continues. Israeli drone strikes killed 3 Hezbollah commanders, while Iran staged missile drills.
This confirms the continuation of the dynamic we call Mabam, the Hebrew acronym for the fight between wars. This isn't a stable ceasefire. It's a controlled conflict designed to constantly degrade the enemy without triggering a full-scale regional war. Both sides are constantly creating facts on the ground.
So when you put this all together, the yen, the gold price, the Caribbean blockade, the trade truce, the digital threat, what's the core conclusion for a global decision maker?
It synthesizes into one unavoidable conclusion. We are living through the collapse of the old order and the absence of new rules. Policymakers have to abandon the traditional playbooks. A rate hike no longer guarantees a stronger currency. A ceasefire doesn't mean the fighting stops. You have to focus on the unique context of each event. The world is now defined by the extreme localization of risk, a seizure off Venezuela, an attack in Sumi, but the effects are instantaneously globalized, driving gold prices and rupturing supply chains thousands of miles away. The most valuable asset in this asymmetric world isn't a specific currency or commodity. It's a capacity for flexible adaptation and accurate, nuanced intelligence because risk is no longer linear. Neural pulse. Clarity in a complex world. See you tomorrow.